Yeah, no, I think it's interesting, isn't it? I mean, everybody's now talking about rate increases in the US, but they're talking about very small ones. So I don't think it's going to have this sort of massive impact on the markets. And I think Powell also is very conscious that we're in an election year and they don't want to do anything to necessarily shock things. So I'd imagine it'll be a pretty benign statement this afternoon. I mean, what's interesting is the inflation drivers in the US are very different to what we're seeing in Europe. So you can see European inflation is trending down, a bit of a lag in the UK probably because of latency on Brexit matters. But obviously in Europe it was driven by an energy price shock, whereas in the US it's been driven by wage growth, sustained wage growth, and now shelter costs increasing. So the kind of inflation that we're seeing in the US is very different to the UK, and I think that's the difference this time around. Normally the UK follows the US inflation environment, but this time it's quite different.
Can we get into the health of the consumer? Because we did have an update on how those behaviours are playing out, and McDonald's was the one that was talking about the impact on low-end consumers. Those behaviours are changing. You know, the great thing about the US is that there's a lot of fast food. They make it very convenient to take food away. But when the consumer is now saying, look, that's too expensive for me to do, I'm going to prepare food at home or a drink, I'm not going to go and use some of these outlets, which is sort of part of the culture of Americans. Isn't that telling you that there are certain pain points becoming very visible now?
Yeah, I think that's right, and we can see, I mean, there's lots of analysis that's been done on the savings that were built up through lockdown. People obviously were having excess savings at that point. They've been depleted. We're seeing credit card debt is increasing all the time. So I think what we've seen is that people have been told that this is a sort of transitory effect and they've been borrowing money to spend through it. And obviously you have to readjust at some point. I think that's what we're starting to see. And it's quite interesting, isn't it? You're seeing some of the sort of credit heavy things. Tesla were saying that they're starting to see a bit of demand destruction now. We saw Kering Group obviously countered by what we saw with LVMH. But we are starting to see initial evidence that there is demand destruction on the back of rising credit costs, I think.
With that comes opportunity, because obviously there's oscillation in the market. Where's the area, or if you can tell us the trade, but obviously our viewers aren't necessarily front run it. What are you looking to do next is what I really want to know.
Yeah, so I think the easy one, which is quite a boring one at the moment, is just buying government bonds. If you buy US government bonds.
Good opportunity for a better yield here, because the UK government yield has just risen to a 2-week high to 4.53%, up 2 basis points on the day. So you're getting a better yield.
Exactly, and you saw the housing market data this morning. UK very, very sensitive to small moves in the UK yield curve. So yield curve moves up, we start to see house prices fall again. So that is great. You're being paid, you know, almost on short dated government bonds. You're being paid over 5% to wait. So
you are, but the underlying is going down at the same time as well. So it's not a slam dunk trade just because of that high-ish coupon.
Yeah, no, that's right. Although, because of the dynamics of bond pricing, your downside risk is a lot more than your upside risk. So if rates rise another 0.25%, for example, the amount you'd lose is very small compared to the amount you'd gain if it goes the other way. So